momentum dominate thinking.
And Neil, we've got a question from one of our subscribers, and I want to bring that in. This is a question from Kuldeep in the UAE saying, how could the Fed even think about raising interest rates by 1%, knowing very well the risks of starting a worldwide recession? And why is the market even worrying about this? And let me weave this into a broader question, as we've had that 75 basis point move, but big questions around dispersion of the dot plots after that. Just talk to us about the fact that there seems to be no pivot in the dot plot next year and what that means in terms of readjustment for markets.
I mean, the Fed has had a difficult job over the last 12 months, and central banks more broadly. It's very easy to be critical. I don't think there's any question they are behind the curve. You can see that in current inflation. But it would be very difficult to raise aggressively autumn, fall last year, when we still had the uncertainty over the Omicron variant, what that may mean for global economies. I don't think 100 basis points realistically was ever on the cards. Nick Timonos, the Wall Street Journal reporter, seems to have become the favoured mouthpiece of the Fed, and he put 75 basis points out a couple of weeks ago, and that seemed to be telling the market. Since then, the data got slightly worse. I still think it was always going to be a stretch for them to raise 100, given the previous communication and Powell's desire not to be seen to be flip-flopping. But a halfway house in between raising 75, which is what the market was expecting, and raising 100 was to adjust the dot plots up, be more explicit, if he could be, in his press conference comments afterwards. And I think that's what they've done. I mean, from what I can see this morning, there's still a very big divergence between where the market really is, tail end of 23, early 24, and what the Fed dot plots infer. The market believes that relative to the Fed, certainly, that inflation is coming down, and the path of interest rates will not be as aggressive as currently implied by the dot plot.
Neil, I want to delve into parts of the market, and just to remind our viewers that you have a world equity fund, but also a European fund. Small and mid-cap stocks, we know, are right in the thick of it. The direct pathways we talk about, any economic storm, it's where you see often the biggest earnings decline felt as economies falter. So as we look at this space, what do you make of the trade for the rest of this year and into 2023?
As I say, I wouldn't expect anything other than the rest of this year to be challenging, whether that applies to small and mid, who, as you say, for liquidity, various other factors tend to be more volatile, or indeed large cap stocks. They'll have to navigate through the same storm. But as we perhaps can enter 23 with the prospect of a Fed pivot on the agenda at some point in time, as long, of course, as it isn't occurring because of that, we're in a deep recession, then a lot of these stocks are discounting quite a significant negative outturn. Certainly those that are facing the consumer. And again, those in Europe are, unsurprisingly, been more negatively impacted than those in the US, as the energy shock impacts European consumers that much more aggressively than it does the US. But with stocks down in many instances 50% and trading on high single-digit PEs or low double-digit PEs, even allowing for the risk of further earnings downgrades, they're beginning to get more attractive. It's perhaps a little bit too early to pull the trigger for shorter-term money, but if you've got a medium-term outlook, some of those businesses, I think, are discounting an awful lot, and ultimately will come out the other side of this, whenever that is, in a better, stronger position. And typically, when the Fed does start to cut, early cyclicals, such as retailers, respond very well.
Neil, we have another viewer question, which I'll bring to you then as we talk about positioning. This is from Roger Jeremy Camera, based here in the UK, saying, should retail investors favour growth or value stocks in the next 6 to 12 months?
It's a great question, and it's attracted obviously a lot of debate, and there's a lot more nuance that goes into that than perhaps is sometimes covered in some of the conversations around it. I think people invariably take those mental shortcuts to focus at the extremes, either deep value, stocks trading at discounts to book value, or the other extreme, some of those SaaS businesses trading on 10 to 20 times revenue. A large part of that growth versus the value debate, as it pertains certainly for the last decade, has been about the FANG stocks versus the others. Google, Microsoft, Apple comprise such a large part of the US index, and therefore, by definition, a large part of that growth basket. To go aggressively against growth, you're taking a big bet against those. Now, to try and distill all of that down to something that's a bit more actionable and useful to the retail investor, I think some of those big FANG stocks, Alphabet in particular, look very attractive on a medium-term view. However, I would be shying away from some of that very expensive growth that may bounce, and it probably will bounce when the Fed makes that initial pivot, just on the classic long duration Pavlovian response. But I do think a lot of those businesses on very high multiples are looking vulnerable in a new regime, and that new regime will be characterized by higher inflation than we've seen over the last 10 years, albeit lower than what we're seeing currently today. And that, I think, will put a cap on some of those multiples. So I wouldn't necessarily be positioning myself aggressively value versus growth. I'd bear in mind those nuances. I'd like to have almost a barbell of some of those big US consumer behemoths, which are all kinds of purposes, not natural monopolies, but de facto monopolies, and all the economics that are attached to them. And then some of that classic value, early cyclical businesses, such as retailers, who may well respond positively when the Fed starts to cut rates. But again, it's all going to be about stock picking. It's no point just selecting retailers across the board. We have to try and understand what the medium-term dynamic is, what their long-term earnings potential is.
That sounds like it makes it a harder journey if you just want to hold an ETF. And I think this brings in Rich's comments. He's from New York. He's asked us a question for individual investors with a medium-term look, 5 to 7 year outlook. What is your view of holding a concentrated position in FANG stocks? And I think you've just answered that. And perhaps you want to just give us a little bit deeper analysis on Alphabet, which is your top holding in the technology basket, where you've got this positioned in your world equity fund.
Yeah, I mean, simply put, we like the majority of the FANG stocks. We are a little bit more conservative around Meta. As you say, our preference would be for Alphabet first, but we still hold Microsoft. And these are businesses that can scale still in a non-linear fashion. They have all the benefits of digital distribution, very little marginal cost associated with revenue. They've got very strong market positions, rock solid balance sheets. And the biggest risk is, and it's a bit trite to say it because it gets trotted out all the time, is regulation. We've seen repeated attempts at regulation over the years. They've been largely piecemeal. I suspect they'll stay that way. But the big risk is if we saw a more leftwards tilt in US politics, would the US start to regulate Google, Microsoft in particular that much more aggressively? In the absence of that, you've got in Google's case a business that's trading on, I think, around about 19 times cash on the balance sheet. Strip that out, and options and a whole host of emerging technologies, very difficult to value those options. But the core business, given that we think it'll continue to grow free cash flow at a double-digit rate, to me looks one, if not the most attractive stocks in the market today.
Neil, just contrasting your World Fund versus your Europe SRI fund, what you've got is a bigger holding in technology in that World Fund, 24.2% versus 8.6% roughly in technology. Can you just contrast the names too and how the strategy is different from the big names, the likes of Alphabet, SK Hynix, Magnachip Semiconductor in the World Fund versus other names on this side of the world, from Creo Medical Group to Software One and Temenos?
Yeah, I mean, Very simply, they're while being subject to the big picture drivers, European tech stocks, as far as we're concerned, just don't have many of the attractions that the US ones do. Creo Medical is a special situation, and perhaps arguably shouldn't be classified as tech, but it's how we tend to think of it. But Temenos is banking, software business has been around for a long time. It functions essentially as that operating system for many financial businesses. So it has got that annuity stream. It's trying to manage that transition to software as a service or a more subscription-based type model. That's had a few hiccups along the way. We may not be fully through those, but we think it's got a very strong market position. And once it makes that transition from a more sort of initial license fee type model to a subscription one, that the market will reward that. And in the intervening period, there's a possibility that it's a type of business that may attract private equity interest. In particular, there has been private equity rumors swirling around that business for a number of years. Martin Ebner, who is a well-known Swiss investor, has a big stake in it. He can be at the margin a little bit activist. So for us, we try and structure our investments with that sort of right tail optionality, and that we like the attractive resilience of the core business, but there's that right tail optionality of potentially M&A, almost a get out of jail free card. Software One is, as much as you can get, a play on digitalization without being able to own Microsoft. There's a number of these European businesses, whether it's Softcat in the UK, Software One, Crayon in Scandinavia, who are all facilitating the trend to digitalization for SMEs, slightly larger enterprise type customers. And a lot of them are very correlated with Microsoft's performance. So for us, it's a little bit of a chicken way to play that big picture Microsoft trend. So if I had a blank piece of paper today, I'd have a very strong preference for US tech over European. We have, having said that, seen a lot of M&A activity in European tech this year. We saw Schneider acquiring the balance of Aviva, and there's been a lot of mooted activity elsewhere. And we think that we might see more of that in Europe into 2023. On the other side of the equation, those big global players all tend to be not necessarily dominant in their industry, certainly the semiconductor industry, despite the consolidation thematic that has played out over the last 5 to 10 years, is still fairly fragmented, albeit that within certain verticals, it has become much more consolidated. So in the memory space, you have come down to Micron, SK Hynix, Samsung. And as a consequence, pricing, as much as it will always be volatile, has become more rational than it has been in the past. And that's functioned to flatten out the peaks and troughs and profitability of those businesses. We've got a small residual holding in Micron. We sold the large part of that much earlier in the year. And that's approaching a level again where you'd start to think, well, perhaps it's getting a little bit interesting. Book value is around about, I think, $40 a share. We're currently at 50 just now. The shares troughed, I think, 35, 40 early in the pandemic, and they are classic cyclical stock. I suspect the next earnings update from Micron will be poor. It'll be very interesting to see how the market responds to that. Certainly, if the shares sell off aggressively, I'd expect that sell-off to be bought, because the risk reward over the medium term from an industry that's much more consolidated, and from where you've an industry that should see good medium term drivers from developments such as artificial intelligence then buying Micron at sort of 1x book or a little bit over, the risk reward is fairly attractive.
Right. Neil, as we pick our way through the tech sector, I noticed that you haven't brought up one of the big momentum plays in technology, that being Tesla. And we've had a question from Yanni Jin in California asking you what you think of the electric vehicle company. It has rallied off the May, June lows. We've seen that. It's not a top holding in your world equity fund. Why is it not parked there?
Quite simply, I think the risk reward is unattractive. I mean, I've been wrong on Tesla for the last 10 years. I've always been a skeptic. I would never have shorted it, just because I think ultimately what you're doing there is taking a bet ultimately on the personality and Elon Musk and everything that goes around that. I think he's enabled the company to have a very low cost of capital and therefore very difficult to replicate. I have no confidence, and that's not necessarily a negative or a positive, in my ability to forecast Tesla's production and sell through over the next 12 months. To me, the stock looks expensive. But as I say, and I'll caveat that by saying I have been horribly wrong on that name for 10 years.
Neil, I want to get to other stocks that you've been avoiding as I pick through the funds. Mining names in Europe, there's no holdings. Oil and gas, zero. Stable financial, zero, which is interesting because we've got a big move higher for European bank stocks on the back of a series of central bank moves today. And elsewhere, no mining in the United States on the World Equity Fund. Just talk us through some of those areas that you're avoiding and why.
Sure. There is an important distinction to make just before I begin to answer that, and that is because of the SRI labelling on the European fund, we're obviously precluded from investing in oil and gas or mining. Having said that, Karen, you're quite right. In the World Equity Fund, there is no mining exposure. There's a fairly reasonable, I think it's about 10% give or take in oil and gas in world equity space, and that accurately reflects our conviction around both of those sectors. Mining will still probably hold up reasonably well shorter term, but I have again very little confidence, and all our positions are based on what we expect the medium term earnings power of these businesses to be. I have very little confidence in my ability to forecast the iron ore price in particular over the next 3 to 5 years, and therefore ultimately what is the earnings power of these businesses. And why do I have that little confidence? Quite simply, it's a dependence on China. I think China accounts for the last set of data I read, 65% of global iron ore demand. It accounts for 14% of GDP. Now, clearly, that relationship isn't going to align itself in the short term. But I think directionally, there's only one way it's going to move, and as China reorientates its economy, as China grows slower, as demographics ultimately make that inevitable, then I think the iron ore price comes under some pressure. I also think that some of the mining companies are a little bit more exposed to inflationary pressures than, say, the oil and gas ones. That's not to say that oil and gas are immune, but ultimately in a lot of extractive industries, mining, then you have to extract a lot of rock, process a lot of that rock by crushing it, energy intensive. You've got labour costs in there. That can put a little bit more crimp on margins, particularly for those smaller and mid-sized companies, than, say, in the oil and gas space, where extraction tends to be that little bit more straightforward. And in the oil and gas industry, contrasting that with mining and iron ore in particular, I feel a lot more comfortable in terms of the medium-term outlook. I think the oil price will stay higher for longer. I don't see peak global energy demand until the early 2030s, even if Western demand has peaked as emerging markets continue to grow on the back of aging populations, then demand for energy use will continue to grow. And at the same time, the supply response has been very muted. You've seen everything from US shale companies who are not going to increase their rig count to Saudi Arabia, admitting that it's very little it can do to further increase production.
Right.
So therefore, I think that the dynamics are much more attractive in oil and gas.
Neil, I just want to bring in a viewer question here as we talk about the geopolitics and the supply side. This is from John Liu in California saying, I am just concerned about this winter with Russia's limitation on natural gas to Europe and the supply chain choke at Cushing, Oklahoma. Thoughts? I know that you've got in the World Equity Fund, you've got Jadestone Energy, Energean and Savannah Energy. Do you want to just weigh in on this?
Yeah, I mean, I think clearly there is a risk over this winter. It looks like the Europeans have managed to get storage up, but that's kind of all based on the assumption that we'll have a normal winter temperature-wise. If we were to have a significantly colder winter and energy usage only really kicks in from October onwards, then that could put European gas supplies under pressure. And I think all of it just goes to illustrate the isometric nature of oil and gas versus other commodities at this point in time. I think there's clearly much more upside risk to prices than there is downside. So yes, share some of those concerns. I think it's broadly manageable this year, but the big unknown, and this all feeds into the inflation debate, is to what extent is that energy shock not just a one and done 1 year event, but something that persists for two or 3 years. How does Europe get its storage capacity back up again next? This is something that could rumble on for a while yet.
In fact, central banks here, the ECB, having to navigate a series of windfall taxes, caps too, in terms of pricing interventions by governments on the fiscal side. Now, as we talk about the ECB, recently you said that aggregate demand still at 2019 levels. With that picture, the ECB now needs to look at its policy making here, because it is the closest to making a major policy error. What do you think now, fast forward a bit, as we've had other central bank decisions, do you still think there is a chance that the ECB is wrong-footed?
I think the ECB is making a policy error at this point in time. And again, I wish to emphasize, I wouldn't wish to be in any central banker's shoes at this particular juncture. But to me, it looks like aggregate demand is still constrained in Europe. Jobs data has been reasonable, but this is a classic supply side supply shock that central banks should be trying to look through. I think aggressively raising rates and signaling that you're going to continue to aggressively raise rates as the ECB has done is just the wrong policy at this particular juncture. That sort of rhetoric is much more understandable from the Federal Reserve, whereby not only have you seen some supply shock, but I think there certainly was some overstimulus of the economy through fiscal transfers in 2020 and 2021 that built up some inflationary pressure. My base position in general would be, though, that central banks are being too aggressive, and that inflation will come down quicker than they currently expect it. I think we've seen that in a lot of the traded goods space, whether that's from lumber, the freight indexes, DRAM pricing. We're seeing that supply side correct. What central banks are clearly worried about is that we transition from a low inflation regime to a higher inflationary regime, and that inflation of 2022 gets embedded in wage negotiations for the next 12 or 24 months. Frankly, I just don't think that's where we are. I think I read a piece the other day, I think with David Rosenberg, the ex-Merrill Lynch analyst, who referred to this as a price level move, and the working class trying to maintain their purchasing power. I think that's a much healthier way of looking at it than assuming that this is a 1970s wage price spiral, because I see very little signs of that. Indeed, the companies that we speak to at the upper end, IT services, are saying that the market for staff has normalized quite a lot. I mean, I think it was last night that Meta, formerly known as Facebook, said it's going to, or has suggested it may cut up to 10% of its staff. The economy is clearly slowing, and I think central banks need to tread carefully.
Neil, growth concerns too in the UK as we talk about central banks. Bank of England has moved by 50 basis points. Two top stocks of the month that you did a deep dive on, Lloyds Bank and also JD Sports. Do you just want to delve into those for us before we wrap up?
Sure. I'll take Lloyds first because it's a more straightforward bottom-up stock story in the sense of steepening interest rate curve in the UK, feeds very quickly into earnings and ultimately therefore capital generation. You've got a bank that's still trading below book value with a rock solid balance sheet. Clearly, if we were to have a deep recession in the UK, there is the spectre of credit losses on the horizon. But we're a little bit more optimistic. We still think we'll see a recession in the UK, US, globally, but it'd be a plain garden variety, relatively shallow one, and that should be manageable for banks and Lloyds in particular. So essentially, just a play on a steepening yield curve in the UK. JD is a little bit more interesting. That had numbers this morning that were right in line with analyst expectations. Top line growth up 5%. And what you've got there is a business that is sort of around about 1/3 in the US now. And what JD does is it is a retailer of sports goods, not like you might see in Dick's Sporting Goods in the US, but apparel and trainers. So there's a new flagship store in Times Square in New York, if you've been there. And the way that JD approaches the market is very much aligned with Nike and Adidas. They see themselves as premium products. They want those products to be displayed and distributed in the appropriate manner, and JD can do that. So they've been encouraging JD to expand outside the UK, both in Europe and in particular the US, with a view to driving those apparel and trainer sales, essentially increasing the retail density for their product. And that to us is a very interesting medium-term story. And what you've seen in the short term is a business that has been hammered by concerns over the consumer outlook. The shares are down 50% year to date. Ex leases, it's net cash. It's got a medium-term growth outlook, as I say, from the Europe and the US, all trading on 10 times earnings. The risk reward for us at these sorts of levels looks very attractive.
Neil, a final question from our viewer, this one really around protection as we talk about diving into certain parts of the market. Roger Perry saying, do you use a hedging strategy to protect your long-only positions? If so, do you prefer using inverse ETFs or buying puts? Thank you from Roger.
We're somewhat limited by our fund structures as to what we can use to hedge. We have hedged selectively in the past. I think we would take typically agnostic about it. We look at which instrument gave us the best return for the desired holding period. Something that can be on a very, 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 very short term period is inverse volatility ETFs, whereby you're essentially taking a bet on volatility going upwards, and the leverage to that is quite significant. The problem with that is that the role in that is heavily negative, so the value corrodes over time. So I'm not saying it's not a product for retail investors. As I said, I would just look at each point in time what the cheapest option is. At this juncture, quite honestly, if people had the flexibility to do it, owning 2-year US Treasuries on 4% is as good a place as any for your cash at this particular juncture, and see how things develop over the next few weeks.
Neil, we must leave it on that note, but we very much appreciate your time and sharing your views on certain parts of the market, stock calls and areas to avoid. Thank you so much for joining us today. Neil Veitch with us, Global and UK Investment Director, SVM Asset Management. Well, thank you, Neil, for joining us today. It was a terrific conversation. We very much enjoyed that. And to our subscribers, thank you for joining us today as well for what has been a very special episode of the program as we talk about how to position really going into year end. For the latest on these Pro Talk events, don't forget you can go to cnbc.com as we wrap up this recording. There will be a full version of it available on CNBC Pro. Our next edition of CNBC Pro Talks will be on the 5th of October. You can check your email for that invite and enjoy the rest of your trading day.